You're picturing retirement like a slow-motion coffee commercial. Ocean light, a paperback, maybe a smug little smile because you ran the numbers. Then your mailbox coughs up 3 envelopes from 3 different states, each politely asking for a slice of your nest egg. Welcome to the part of retirement planning most highlight reels skip: state taxes. The goal isn't to make them scary, just visible, so you keep more of what you saved and sleep like someone whose mailbox only brings postcards. Start by deleting the biggest myth. I'll move to a no income tax state and I'm done. States are like cats with clipboards, curious, territorial, and very detail-oriented. Some chase domicile, your true permanent home. Others chase statutory residency, a formula built from how many days you were physically there, plus whether you kept a permanent place of abode. The place your toothbrush lives matters, but so do your footprints. If you want a clean break, sell or lease the old home, move the doctors, register the car, change the voter registration, move the safe deposit box, and, yes, move the dog's vet. If you keep one foot in 2 worlds, one of those worlds will send a bill. Don't chant the 183-day folklore like a spell. Many states don't stop at a day count. A few can still consider you a resident if you maintain a real home there and live like a resident, even if your calendar says otherwise. Some run a strict days plus abode formula. Spend enough days and keep a ready-to-live-in home, and you are a resident for tax. Planners may love blurry. State auditors love calendars. In the move year, prepare for part-year residency. Both states will want a slice. You'll file as a part-year resident in each, reporting the months you lived there and the income sourced there. Wages are sourced where you worked, rental income where the property sits, and business or equity compensation under special sourcing rules. Keep a mini diary of when income was earned and where you were when you earned it. I moved in September is cute. I moved on September 12th. Here are my closing statements, lease, utility start dates, and first medical appointment is convincing. Retirement income is a crowd pleaser and a trap. Federal law generally protects non-residents from being taxed by a state on many forms of retirement income. Pensions, 401ks, IRAs after you've moved away. But not everything you'll cash in is protected. Non-qualified deferred compensation, some stock options and RSUs, and bonuses you earned while working in a state can be sourced back when they vest or pay out, even if you've already moved. If you plan a move, model when equity awards vest, when severance pays, and when non-qualified plans distribute. Make the calendar match your new address, not your nostalgia. Some late career remote work carries another surprise: the convenience of the employer doctrine. A handful of states say that if your job is based there, your wages are sourced there, even if you work from another state for your own convenience. If your last working years involve cross-border Zoom life, confirm whether your home office counts as an employer office under those rules. Otherwise, you could fund a state you thought you left. Your house is its own chapter. States with no income tax sometimes hide the bill in property taxes. Before you move, look up rates, assessment cycles, and senior exemptions where you want to live. Ask whether there's a homestead exemption, a 65-plus freeze or circuit breaker, and whether property tax benefits are portable when you downsize. When you sell in the old state, learn the seller side withholding rules. Several states make closing agents withhold a percentage for out-of-state sellers. It's a prepayment, not a punishment, but it will surprise you if you meet it for the first time at the closing table. Sales tax and insurance hum in the background and quietly add up. In retirement, you often spend more on lifestyle than wages. If you relocate to a state with high sales tax and local add-ons, your everyday spending turns into a treadmill. Combine that with homeowners insurance and wind or flood premiums in a coastal paradise, and you can spend more than you save from a lower income tax. Retirement isn't just a tax bracket, it's a shopping cart. Social Security is simpler than rumor. Most states don't tax it. A few do, often with income-based exceptions or credits. Don't memorize a map. Rules change. Just check your destination's stance and whether it phases out tax above a threshold. Pensions and IRA withdrawals vary wildly. Some states exclude government pensions, some cap private pension exclusions, some love Roth distributions, some don't care. Your Roth conversion strategy, when to convert and where you live when you do it, can move real money. Many people convert in the gap years between retirement and required minimum distributions. If those gap years will be in a low-tax state, convert there. If you convert in a high-tax state right before you move, you just tipped your waiter twice. Capital gains play by state-specific rules too. Most states tax them like ordinary income, though a few offer quirks. The trap is timing. If you plan to sell a big position or a rental, ask which state you want to thank for this gain, because the tax follows the date you sell. For rentals, there's the bonus sting of depreciation recapture, which returns as ordinary income on sale and is sourced to the property's state. Exit with eyes open. Healthcare isn't a tax, but it's tax-shaped. If you'll use an ACA marketplace before Medicare, your premium credit hinges on taxable income. A state with income tax might also have its own marketplace rules. Roth conversions can raise income and shrink your credit. So can large capital gains. Do the healthcare math before you pull a tax lever, not after. Local taxes matter in a few places. City or county income taxes can ride on top of state systems. They're smaller but sticky, and they turn a good headline rate into something more complicated. Let's make this real with 6 mini-movies. In the two-porch problem, you keep your old house for the grandkids and buy a condo in a no-tax state. You move the driver's license and voter registration but spend long stretches back home. Your doctors and club membership remain there. And your packages still love the old porch. The old state argues you never truly left. The new state smiles and taxes you as well. The fix is simple but grown up. Sell or truly convert the old place to an arm's-length rental and move your life, not just your luggage. In the calendar crime, you plan a giant Roth conversion in November and move in February. You saved your future self federal tax pain, but you paid the old state for a party you could have hosted in the new one. Sequence the move and the conversion so you convert after arrival, where rates are friendlier. In the equity ambush, your last grants of RSUs vest the spring after you retire. You're sipping iced tea in your new state when your old state sends a bill. Those shares were earned while you worked there, and a portion is sourced back. Understand the vesting schedule and sourcing rules. If your employer allows, shift vesting or settle while you're still a resident where the math is best, or at least model the cost so the bill doesn't feel like betrayal. In the rental goodbye, you sell a rental after you move. The old state withholds a chunk at closing because you're now a non-resident, and later you discover depreciation recapture and a local transfer tax. Nothing is dramatic if you expected it. Get the withholding certificate rules, depreciation records, and local levies lined up before you list. In the friendship bracelet, our nickname for the convenience rule, you live in State A and your company is based in State B. You work from home by choice, so State B taxes your wages anyway. Now both states want a taste. Your new state may give a credit for tax paid to B, but credits don't always wipe everything. Confirm whether your home office qualifies as an employer office under their rules, or adjust payroll location if your employer will play ball. In the sales tax spiral, you move to paradise. Buy furniture, a golf cart, and redecorate like a TV pilot. The state has a high combined sales tax plus steep insurance. Your income tax savings are eaten by receipts that look like scrolls. Plan net living costs, not just the tax headline. Sometimes a low-income tax state with moderate property costs and reasonable sales tax quietly beats the rock-bottom income tax superstar. Now for the tactics, the good boring ones that work. Make domicile obvious. Close the loop. Sell or lease the old home on commercial terms, get the new state license and voter registration, move physicians, club memberships and professional ties, update estate documents to the new state, move safe deposit boxes and primary mailing, change your bank, and keep travel logs for the first year. Time the big taxable moments. Do large security sales and conversions after arrival where it's friendlier. When you sell property, know the reporting windows and required withholdings. Watch senior benefits. Some states offer pension exclusions, retirement credits, or Social Security exemptions with income thresholds, while others give little but cap property taxes for seniors. The best state is the one that fits your mix of income and home value. Use credits intelligently when two states touch the same income. The resident state often gives a credit for taxes paid to the other, but credits don't apply to everything, especially certain local taxes or categories. When you cross state lines mid-year, map which slices get credits and which don't. Re-aim your giving. Charitable gifts of appreciated stock can erase state capital gains the same way they do federally. If you're selling a concentrated position, gifting shares directly to a charity or donor-advised fund after you move can make the forgiven gain disappear at the state level too. Tie to your estate plan. A few states still levy estate or inheritance taxes with thresholds lower than federal. Changing states can change the math on what your heirs see. Title, beneficiaries, and trusts often matter more than your zip code. Estimate like a pro. The year you move, your old employer's withholding may not match reality. File estimates in both states if needed, especially if you'll have big capital gains or conversions. Penalties are cheap to prevent and annoying to pay. And keep proof of when. Part-year returns live and die by dates, so save closing disclosures, lease start letters, utility start emails, moving invoices, medical appointment receipts, and insurance policy start dates. It's dull, and it's effective. People whisper 3 questions they don't want to say out loud. Will moving for taxes ruin my life? No. If you pick a place you actually love after the honeymoon. Taxes are one variable. Community, healthcare access, travel costs, climate risk, and family outrank a bracket. Is it shady to move for taxes? No. The rules anticipate it. Just live the move. States punish pretense, not optimization. What if rules change? They will. Favor durable strategies, clear domicile, clean documentation, diversified income sources, flexible timing for gains, and enough cash cushion to adjust without selling the wrong thing on the wrong day. Retirement isn't a magic doorway. It's a change in how money moves. State taxes are the toll booths on that road. If you know where they are, you glide through at the speed limit, wave at the attendant, and keep driving toward the life you picked on purpose. So don't retire until you've run this play. Pick your state with a calculator and a heart. Make the move unmistakable. Time the big taxable moments. Collect the dull paperwork, and let the system work for you. The coffee still tastes like a commercial. The difference is your mailbox only brings postcards.